4:1 Risk Management and Portfolio Construction. 4.1 Diversification and Risk Control. Diversification plays a crucial role in sector rotation strategies as it helps manage risk and enhance the overall performance of the portfolio. Here's how diversification contributes to sector rotation strategies. Risk mitigation. Diversification helps reduce the specific risks associated with individual sectors. By allocating investments across different sectors, you spread the risk and avoid overexposure to any single sector. This is important because sectors can experience significant volatility and fluctuations due to various factors such as economic conditions, industry-specific events, or regulatory changes. Diversification helps cushion the impact of poor performance in a particular sector by allocating capital to other sectors that may be performing well, smoothing returns. Sector rotation strategies aim to capitalize on the relative performance of different sectors. However, accurately timing sector rotations can be challenging. Diversification helps smooth out the overall returns of the portfolio by reducing the impact of short-term volatility and potentially poor timing decisions. It allows you to capture gains from outperforming sectors while mitigating losses from underperforming sectors, resulting in a more stable and consistent return profile. Opportunity capture. Diversification ensures that you have exposure to a wide range of sectors, enabling you to capture opportunities across various market conditions. Different sectors perform differently based on market cycles, economic conditions, and other factors. By diversifying your portfolio, you increase the likelihood of having exposure to sectors that are performing well, even if other sectors are experiencing challenges. This allows you to participate in market upswings and potentially benefit from sector-specific trends or events. Risk-return trade-off. Diversification allows you to strike a balance between risk and return. By diversifying across sectors with varying risk profiles, you can construct a portfolio that aligns with your risk tolerance and investment objectives. You can allocate a portion of your portfolio to growth-oriented sectors with higher risk and return potential, while also including defensive sectors that provide stability and act as a hedge during market downturns. This balanced approach helps optimize the risk-return trade-off and improves the overall risk-adjusted performance of the portfolio. Long-term performance. Diversification is particularly important for long-term investors. Over time, different sectors go through cycles of outperformance and underperformance. By diversifying across sectors, you avoid the risk of being heavily concentrated in a sector that may underperform for an extended period. Diversification helps ensure that your portfolio remains resilient and can withstand changes in sector dynamics over the long term. It's important to note that while diversification can help manage risk, it does not guarantee profits or eliminate all risks. It is still crucial to conduct thorough research, monitor market conditions, and regularly review and rebalance your portfolio to ensure it aligns with your investment goals. Managing risks associated with sector concentration and market volatility requires careful planning and risk management strategies. Here are some key approaches to consider. Diversify your portfolio. Avoid excessive concentration in a single sector by diversifying your portfolio across different sectors and asset classes. Allocate your investments across a broad range of industries, geographies, and investment types, such as stocks, bonds, and commodities. Diversification helps reduce the impact of sector-specific risks and provides exposure to different sources of returns. Regularly monitor and rebalance. Continuously monitor the composition and performance of your portfolio. Periodically review your sector allocations and rebalance if necessary to ensure they align with your desired risk tolerance and investment objectives. Rebalancing involves selling sectors that have become overweighted and buying sectors that have become underweighted, bringing your portfolio back to its target allocation. Set risk limits and stop losses. Establish risk limits for individual sectors or your overall portfolio. Determine the maximum percentage of your portfolio that you are willing to allocate to a single sector, and stick to those limits. Implement stop losses or trailing stop orders to automatically sell positions if they reach predetermined price levels, limiting potential losses during market downturns or sudden sector declines. Implement risk hedging strategies. Consider using hedging strategies to mitigate sector-specific risks and market volatility. For example, you can use options or futures contracts to hedge against potential downside moves in specific sectors. Hedging allows you to protect your portfolio against adverse market movements while maintaining your sector exposures. Stay informed and conduct research. Stay updated on market and sector-specific news, economic indicators, and industry trends. Conduct thorough research on the sectors you invest in, including understanding their fundamental drivers, competitive landscape, and potential risks. Stay informed about any regulatory changes or macroeconomic factors that could impact sector performance. Employ active portfolio management. Adopt an active portfolio management approach that involves continuously monitoring and adjusting your sector allocations based on market conditions and sector-specific factors. Stay flexible and be prepared to reallocate your investments based on changing market dynamics. Economic outlook, or sector-specific events. Consider professional advice. If you are unsure about managing sector concentration risks or navigating market volatility, consider seeking professional advice from financial advisors or investment professionals. They can provide insights, analysis, and recommendations tailored to your specific investment goals and risk tolerance. Remember that managing risks is an ongoing process, and it requires regular monitoring, evaluation, and adjustment of your investment strategy. Be prepared for market fluctuations and stay disciplined in adhering to your risk management principles.